how can debt be a good thing? In fact, many of us are raised to believe that debt is the source of all evil and it has to be avoided at all costs. But that's not true. There are many forms of good debt. Think about it. When you plan to buy a house, in many cases, we don't have enough cash to actually pay for the house itself. So we have to go to a bank and ask for a mortgage. And that's where you put in a portion of the purchase price for the house, and the remaining portion of it is actually lent to you by the bank as a mortgage. That's a form of a good debt. Why? Because in that scenario, you're investing in an asset such as a house that over time, for the most part, actually increases its value. It appreciates. Aside from that, you are actually getting benefit by living in the house, or sometimes even using a house as an option for you to invest. For example, you can rent it out, or possibly even rent a room or two within your house to generate some income. The good debt is categorized as those type of debts that are actually allowing you to generate some sort of income, or in other words, they're assets that their value over time increases. Whereas a bad debt, if you think about it, could be something that does not offer that. For example, if you go buy a car that perhaps you don't need, or a car that over time is going to depreciate, that's a form of a bad debt, particularly if you're going to borrow money to use that to buy that car. Now, don't get me wrong. I'm not saying that you cannot go and buy a car, especially if that's something that you need. But what we're talking about is that, kind of changing your lifestyle and always wanting to spend money on things that perhaps you can't afford is not going to be a sustainable way for you to reach financial freedom. Instead, you want to be very selective and decide when you want to borrow money and what are you going to use that money for. In this video, we're going to be talking about the Smith Maneuver. It's a technique that allows homeowners in Canada to tap into their home equity and capitalize and use that money, in other words, borrow it to invest. And that's a form of a good debt. Let me explain why that's a form of a good debt. First and foremost, when you set up your mortgage in your home in a right way, it must be a re-advanceable mortgage that allows you to borrow your home equity through a home equity line of credit. You are tapping into kind of a funds that existed in there, but before that, you never had access to it. As you pay down your mortgage year after year, the ownership that you have in your house goes higher, but without having a right setup in terms of your account to be able to access those funds, you wouldn't be able to borrow that, to repurpose that and invest. Whereas through a Smith Maneuver, that's an option that actually is available for you. And what the beauty of this technique is that the money that you borrow, that debt, as long as you use that to invest in the right source of investment avenues that allow you to earn an income. For example, if you invest it in the stock market, or to buy a rental property, or similar type of avenues, that interest that you pay to borrow that money is actually tax deductible, which is remarkable because before this in Canada, you wouldn't have had that option to actually deduct the interest that you pay on your mortgage as a tax deductible kind of benefit. But here, through the Smith Maneuver actually technique, you're able to do so. But in doing so, you need to gradually over time convert your mortgage into a tax deductible kind of investment. And you do so by setting up the right level of accounts for your mortgage, and gradually, as you pay down your mortgage, reborrow that funds to then invest. A common question that many Canadians might ask who are new to Smith Maneuver is whether this is a risky approach, because they might think that by opting in for the Smith Maneuver, maybe they are increasing their debt. But the truth of the matter is, with the Smith Maneuver and it's at its plain Jane format, this most simple format, you're not actually borrowing anymore. All you're doing is you are kind of converting your amount of mortgage over time to a different type of debt. In other words, you're converting it from a bad debt to a good debt. And that's really the beauty of it. You're not borrowing anymore, but you're maintaining your debt level at the same level. Of course, there is some level of risk involved. Let's say, particularly if you were thinking that, over time you want to decrease your debt, and this might not be for you. for sure, this is definitely something that you need to be comfortable with, and also you need to understand what is your own risk tolerance. But that is where, for those investors and those individuals who are looking for kind of building that financial path for themselves and taking advantage of the low interest rates, this could be a unique opportunity, because over time, as you borrow the money, you can invest it. And in our case, we are using that equity to borrow and then invest it in the stock market. And I'm going to show that to you in a moment. So why don't we take a look at our investment portfolio that we have with Questrade, dedicated for our Smith Manoeuvre portfolio. And I explain to you how we've been doing so far and what's the progress. So let's take a look.
Is everyone ready?
As you notice here on the screen, the current balance for our individual margin account with Questrade is currently at $76,805. Although our net deposit was slightly higher at $78,284. This is because, in fact, the investments that we've had is actually over time showing some negative return. And you notice we've only invested in one ETF, and that's VEQT. That's the Vanguard's all equity exchange rate fund ETF that gives us 100% exposure to stocks. And it is a very diversified ETF as well. It gives us exposure to about 40% American stocks, about 30% or so to Canadian stocks, and the remaining is to international markets. So in that sense, it's an all-in-one ETF that takes care of all those rebalancing and diversification for us. In terms of the return for our holdings, as I indicated, we have 2,164 shares of VEQT, and average purchase price has been at $36.45 roughly. Given the last trading price and closing price for VEQT, we are currently down by 2.65%. The market, as you know, has been quite volatile in the past several weeks. So we've been trying to continue to buy and dollar cost average every day through the funds that we add gradually to this VEQT. And all of these funds are based on our actually home equity. And as we pay down our mortgage, we managed to transfer more of those funds into this account to our line of credit and add to our existing shares. Let's take a look at the VEQT overall returns over the past several time frames. In the past 1 year, VEQT is currently showing a positive return of 8.14%. The past 6 months, it is showing a negative fraction of a percent of only 0.81%, less than 1% negative return. In the past 3 months, it is showing a return of 4.65% negative. And the past 1 month, it is showing a negative return of close to 2%. When I do see these negative returns, not only that actually does not make me worried, but in fact, it actually is a good sign for me, because for me, I'm here for the long term. And if I see that I wanted to already buy shares of VEQT, and I know that I'm investing in the overall stock market, and I know that long term, the stock markets tend to grow over this long span of time. So if I get then to buy these shares at lower prices, I consider them as more of a discount. And in fact, I would be happier. So for me, in the short span of time, I don't mind if the market is doing poorly. Again, like I said, I'm looking at it the longer term time horizon, and we're talking about around 10 to 15 years. So that's not something that we are worried about. The 1 week return is negative 0.59%, and today's return was negative 0.62%. So we'll definitely continue to add more to our existing shares. Keep in mind, this number is going to definitely grow. The VEQT, for those investors who would be interested in dividend investing, the question might be whether it does pay a dividend. VEQT is slightly different. It does pay its dividend or distributions, as it's an ETF, once a year. Typically, it pays it in the month of January. The last time I believe that they paid it was back in this January, and it was close to 51 or 52 cents per share in terms of the distributions. As we are growing these shares, we anticipate that our distribution dividend amounts next year is going to be definitely much higher than what we had. And we have opted for kind of dividend reinvestment plan, the DRIP plan. And what that means is that as we earn these distributions or dividends, they are automatically used to buy more shares of VEQT for us. Just some key statistics around VEQT. The 52-week low price for it has been at $31.54, and the 52-week high price is at $37.72, and it has a market cap of $1.15 billion. If you have any question about Smith Maneuver and want to learn more about, be sure to check out some of our other videos whereby we've explained it a little bit in more details. And also we talked about the amount of dividend that we've earned and how this account has got to this point over time. So that might be of interest to you. If you have any specific questions, feel free to reach out to us by leaving us a comment. If we know the answer, we will definitely provide it to you. And if you don't, we'll try to connect you to either the right resource or to the right information where you can actually reliably find out the answer to your questions. I hope you found this video beneficial and you gained something of value from it. If you did, leave me a comment down below and let me know what you thought. And of course, give this video a thumbs up. Don't forget to subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, whether it's investing in the stock market, cryptocurrencies, and real estate, as well as ways to reach financial freedom. Thank you, and I hope to see you next time.